Hello, investors and traders, and welcome to the weekly market report. This is AJ Monty, and what we're looking at here is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And as I zoom in here, you will see the lines that I drew from last week right here. Let me zoom in a little bit more so you can see that. And I said last Friday we saw this hammer pattern here, long shadow underneath, giving us an indication that the buyers were moving in, especially on the close last Friday. And what happened? We rallied right back up. Now this line right here was my forecast, the end of the line being my target. So it should be obvious to see that we blew right past that target and even blew past this resistance point right here. So what does that mean for next week? In order to make this clear for you, let me erase all of these lines and start right at the top, right there. That candle is a nice green candle on higher volume. Normally, that would be bullish. So we will check that off as a slightly bullish indication. But what's got my attention right now is the fact that we have a long stretch of green. We have 3, 6, 8 green candles in a row, and that's known as a stale green light. So while we do have a higher volume, I would expect a lower volume day on Monday, possibly a doji or some type of a red candle up here. And then I think we're going to start to pull back. Why do I think that? Because the oscillators down here are showing a weakness in that momentum. We see the stochastics right here at the higher level for the month, right there, overbought, hasn't turned yet. But the more sensitive indicator right here is the CCI. Now, I just did a call with John Nigerian and the team there at Market Rebellion, and I pointed out the CCI having the most powerful signal in the CCI is when you have divergences. Notice we have a high back here on a higher CCI, but today we close with a higher price on a lower high for the CCI. That's known as a negative divergence. So again, I'm standing with that forecast that we're going to go lower. If you need a price target for the diamonds, that's going to be 267.66. And now I will move on over to a more broad-based index, which is the Russell 2000. Same scenario, except the Russell 2000 has a bullish candle right there. That's a bullish engulfing pattern. So let's take this one step at a time. Last Friday, I said we would most likely move up. We did move up over that slight resistance here, and we continue to go higher. But like the Dow, we're seeing a drop in the CCI with that green candle. Taking a step back a little bit further, we are just barely over this resistance right here, and we see a wide divergence from this moving average. So again, let me erase all lines, draw my forecast. I think the Russell 2000 could actually go a little bit higher, unlike the Dow. I think it's going to start pulling back. But I think the Russell 2000 could go a little bit higher before pulling back just like that. And there is a gap down here that I think will eventually fill. That gap, once filled, will act as a support level. So if you're looking for a good stop loss level, that support level would be right there. All right, keep an eye on that CCI, because once this CCI moves down below this red line, that's when the sell signal is generated. Now let's take a look at the tech sector represented here in the Qs. The Qs went up exactly as I said it would. Look at that. Right here was Friday, Monday, Tuesday, Wednesday, Thursday, today, Friday again. The end of the line being my target, I said we would most likely test that resistance. We have done that. So now that we've hit my target, let's erase these lines and analyze the charts. This red candle that falls within the body of this green candle is known as a bearish harami. That bearish harami is as bearish as what we saw back here in a bearish engulfing pattern. They're more or less in the same class, hold the same significance as a sell signal. And notice this, red candle on higher volume tells us that the sellers are getting motivated. So out of the indices that I pointed out already, the Qs look more bearish than all of them. I do not think the Qs are going to break into a new high for the month. I think, in fact, it's going to pull back to fill this gap. By the time the stock pulls back to this gap fill point, the moving average will have gravitated up, so we'll have more or less an intersection of price on the moving average. All right, now moving down to the oscillators, it's obvious to see that the stochastics is starting to turn lower. The CCI has already turned lower, and we are very close. In fact, we are just 2 hairs away from creating a sell signal right there. As that blue line, the CCI, crosses below the plus 100 mark, that's when the sell signal is generated. Notice one thing. See the angle in which I drew my forecast line? That more or less mimics the angle that we see in the speed line right here. So when you're drawing speed lines, what you want to do is more or less intersect the mean, and you'll see that there's similar angles right here. So all I did is I took that same angle and I just transposed it over to the side from that high and then drew it to fill the gap. So that's how I'm drawing my forecast right there. Now let's go to the VIX, and then I'm going to close with the S&P, or the spiders. Last week, I said that the VIX would most likely break out below support. It did exactly that. The end of the line right here is my target from last week. Look at that. It doesn't get any better than that, folks. On Thursday, right there, the low for the VIX hit to the penny on my forecast. Now, what does that mean? Well, notice we do have another red candle, but as I erase these lines, I want you to count the number of red candles. 1, 2, 3, 4, 5, 6, 7, 8 red candles in a row. What does that mean? We're long overdue for a green candle. Notice how the CCI is starting to move up. The stochastics is barely oversold, but the CCI, again, being more sensitive, I see that more as a leading oscillator to the stochastics. I think that the VIX is going to start to move up and eventually pull back to this moving average right there. So if you're looking to make the trade on the VIX, the end of that line is going to be 25.15, and that's my target for next week. Now, the VIX is inversely related to the S&P, so let me put in the S&P. We're most likely going to see the opposite here. I did say that we would break out of this resistance and move higher. End of the line right there, as I zoom in for you, the end of the line is my target. We hit that on Wednesday to the penny, opened up on Thursday to the penny, trade a little bit higher, but we have this long stretch of green right there. And as I erase these lines, I want your eye again to gravitate down to the CCI. See down here, we are seeing higher highs on this stale green light, but we're seeing lower highs. In fact, after a higher high and a higher low today, the CCI still went lower. And again, that's bearish. I'm expecting the CCI to move lower and actually cross with a sell signal. When the CCI crosses below the 100 mark, the sell signal is generated. So I think that we're going to see the S&P pull back again, possibly to fill this gap, and by then the moving average will be up. So I think we're going to see a reversion back to, not necessarily the mean, but a reversion back to the moving average, a retraction to it, and then we could look for new buying opportunities as this gap fill area acts more or less as a support level. So that's it for our weekly market report. You have a great weekend, and I'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.